Okay, so 8% yield. Right. I mean, in this economy, who wouldn't at least be a little tempted by that?
Yeah.
Right? It's like almost too good to be true, right? It's like finding a $100 bill just laying on the sidewalk.
Right.
But, this sidewalk might be in a bit of a sketchy part of town.
Yeah, there you go. You got to be careful.
Exactly. So we're diving into the world of high-yield dividend stocks today.
Yeah.
Potentially lucrative, but, not without their quirks, let's just say.
Absolutely. High risk, high reward.
There you go. And we've got our shovels ready, because you, our wonderful listeners, have been asking us to really dig into this.
Yeah.
And we've uncovered this article that highlights 3 companies that are catching a lot of investors' eyes right now.
Right.
All promising that juicy 8% yield.
It's tempting. It is very tempting.
Oh, for sure. So let's jump right into it, shall we?
Let's do it.
First up on our list, we've got Brandywine Realty Trust.
Okay.
BDN, if you're a ticker tape person. Now, this one is interesting because, get this, their stock is up almost 50% in the past year.
Wow.
In this economy.
Yeah.
So what's the deal there?
Right. What's their secret?
What is their secret sauce?
Mm-hmm.
Well, they're a REIT, which basically means they're all about real estate.
Okay.
But specifically office buildings.
Interesting.
And I can already hear some of our listeners like scratching their heads right now, right?
Right.
Office buildings.
In the age of working from home?
Exactly.
What's going on there?
And the age of, death of the office, all that jazz.
Right.
Seems a little counterintuitive, doesn't it?
It does. It does. So how are they making this work?
Well, and that's what I think is so interesting. It's not like they're just holding on to these, outdated office spaces.
Mm-hmm.
They're focusing on prime locations. Think like they've got properties in Philadelphia.
Okay.
They're in Austin, Texas.
Yeah, those are hot markets.
Hot markets,
Yeah.
exactly. And they're not just offering cubicles, you know what I mean?
Right.
They're high-end amenities,
Okay.
collaborative spaces.
Sure.
Kind of like that whole WeWork kind of vibe. you know?
Yeah. I see where you're going with this.
So they're betting on companies still wanting these in-person connections.
Okay.
And judging by their occupancy rate, which is sitting at a pretty nice 87%, it seems to be working.
Wow, 87%. That's pretty impressive. Especially given all the talk about empty office buildings these days.
Exactly.
So that's got to be appealing to investors. That and, that 9.6% dividend yield.
Oh, yeah. And we can't forget about that juicy dividend yield, 9.6%.
That'll get your attention.
It definitely will.
Yeah.
And for those of you who speak chart out there,
Right.
the article actually calls out some really positive technical signals for BDN.
Okay, like what?
Well, they mentioned this thing called the 200-day moving average, which, now, you're the expert here. Correct me if I'm wrong.
Sure.
But that's basically like a trend line that kind of indicates continued growth.
Right.
When a stock stays above it.
Yeah, you got it. Think of it like it's kind of like a long-term popularity contest for a stock.
Okay.
If it's trading above that 200-day moving average, consistently above it, it means that, generally speaking, investors are feeling good about it. They're buying it.
Okay.
It's not a foolproof predictor or anything, but yeah, it's definitely a good sign.
It's a good sign. So we've got positive momentum. We've got a solid business strategy. We've got that tempting yield.
Right.
But, and you knew there was going to be a but.
There's always a but, right?
Always a but, right.
Especially with investments.
Yeah. The article also mentions that BDN recently lowered its forward guidance.
Okay.
Now, again, I'm not the financial whiz here. That's your department. But that doesn't sound like the best news, does it?
Yeah, so you're right. It's not, it's not necessarily a reason to celebrate.
Right.
Forward guidance is basically the company's prediction about its own future performance. So when they lower it, they're essentially saying, we're being a little cautious here. We might be hitting a few bumps in the road.
Oh.
It's not all, smooth sailing, even with these high yield stocks. You got to keep an eye on those things.
So, take away from BDN.
Yeah.
There's potential.
Yeah.
But always important to kind of keep an eye out on those,
Be aware.
Yeah.
Be aware of what could go wrong.
Those storm clouds, right?
Exactly. Due diligence is key.
Due diligence is key. Always, always.
Okay.
On to our next contender. We've got Main Street Capital.
Okay.
Ticker symbol.
Mm-hmm.
MAYN.
Right.
This one's a bit different.
Okay.
They're what's called a Business Development Corporation.
Right.
Or a BDC. Now, full disclosure, I had to do a little bit of, explain it to me like I'm 5 research on this one.
Sure.
What exactly is a BDC?
Yeah.
And, more importantly, Why should we care about them?
Right, right. Well, imagine you've got a small business, right? And they need a loan, but maybe they don't check all the boxes for a traditional bank loan.
Okay, maybe they're a little too risky, a little too new, whatever.
Right.
That's where BDCs come in.
Hmm.
They provide financing to these companies, often in the form of debt, and they make money from the interest payments.
Interesting.
So they're kind of like a specialized lender for these companies that might not have access to those big banks.
Okay, that makes sense.
And Main Street Capital, they focus on what's called first lend, senior secured debt.
Okay, now you're just using big words to try to confuse me, I think.
Oh, no, not I promise.
First lend senior. I'm getting flashbacks to, like, my finance class in college, which I'm pretty sure I doodled through most of.
Fair enough, fair enough.
So break it down for me.
Okay.
What does all that first lend stuff actually mean for someone who's more interested in, dividends than debt structures?
Right. So essentially it means that if a borrower defaults, Main gets their money back first.
Okay.
They're first in line. Less risky than other types of debt. Think of it like calling dibs but for getting your money back. So it's like a little more security than your average high-yield stock.
You could say that, yeah. They've got a bit of an advantage.
Interesting. And speaking of security, they've consistently increased their dividends since 2007.
Oh, wow.
That's a pretty solid track record, wouldn't you say?
Yeah, especially with everything that's happened in the market since 2007. That's saying something.
Right. Plus, the article points out that their total return, including those lovely dividends, has really outperformed the S&P 500.
Yeah, by how much?
Over the past 3 years, we're talking over 54% return for Main Street Capital compared to the market's, well, let's just say less than stellar performance.
Yeah, significantly less.
Significantly less.
So they're doing something right over there.
It seems like they are.
They've certainly demonstrated an ability to navigate those different market conditions, which is always reassuring, right?
For sure, for sure.
But, and I hate to sound like a broken record here, but past performance isn't a guarantee.
Right. Past performance is not indicative of future results.
Exactly. And in Main's case, it's especially important to remember they operate in a space that's really sensitive to those interest rate fluctuations.
Right.
The economy, the big picture, it all ties back to how well those smaller businesses they're lending to are actually performing.
That's a really good point. So to kind of sum up Main Street Capital here, they've got a pretty solid history.
Yep.
They've got that interesting niche, right?
Yeah, that first dibs lending strategy, that's pretty unique.
Yeah, the first dibs lending strategy. And of course, they have that attractive dividend.
It's a tempting package.
It is tempting. Okay, you ready to meet our final contender? Our final company in this 8% yield lineup.
Let's do it. Hit me.
All right. Last but not least, we've got Ayers Capital.
Okay.
Ticker symbol, ARCC.
Mm-hmm.
Like Maine, they're playing in that private credit sandbox.
Okay.
Providing financing to those not-so-big businesses.
Gotcha.
And get this, their yield sits at a cool 8.9%.
Wow. All right, so they've upped the ante here a little bit.
They're bringing the heat.
They're bringing the heat.
Right.
Got to pay attention to this one.
But, and I'm sure you saw this coming, there's always a but.
Of course. What's the catch?
Right. There's always a catch. There's this little thing called a coverage ratio. And apparently, it's kind of a big deal.
It is a big deal.
So, Enlighten me, oh wise one. What is this coverage ratio? And why should I care about it?
All right. So the coverage ratio, it's crucial when we're talking about dividends because it basically tells you how easily a company can afford to actually pay those dividends, from their earnings.
Right.
A strong coverage ratio, which ARCC has, means that they're not scraping by just to make those payments.
Right.
They've got breathing room, which can mean a little more peace of mind for investors.
Yeah, nobody wants to be getting a dividend and then suddenly it's like, oh, sorry, we can't afford this anymore.
Right, exactly. Dividends aren't guaranteed.
No, they are not. So, okay, I'm following you so far. They're making money, they're sharing the wealth, and they're not sweating about it.
Exactly. Got it.
So far, so good.
But here's where I get a little bit tripped up.
Okay.
The article mentions that ARCC has actually, get this, trailed behind the S&P 500 over the past 5 years.
Interesting.
How does that even compute with everything else we've just talked about?
It's a fantastic question.
Yeah.
And it just goes to show you that, as much as we like to look at past performance, it doesn't guarantee anything.
Of course.
The market is a wild beast.
It is.
It could be that other sectors were just, hotter during that time period.
Right.
Maybe ARCC faced some headwinds specific to their business. Who knows? But it is a good reminder
Right.
that there's always more to the story. You got to look beyond just that yield.
It's not as simple as just, 8% yield, sign me up.
Exactly. You got to understand what's driving the performance.
Dig a little deeper. Exactly. And that's especially true with private credit, right?
Oh, okay.
You got to understand their lending practices, the industries they're involved in, how they manage risk.
Okay. So ARCC, high yield, strong coverage ratio, but a little bit of a head scratcher when we compare their track record to the broader market.
Right. Doesn't necessarily mean it's a bad investment or anything.
No, not at all.
But it does mean you need to do your homework.
Exactly.
Ask the right questions.
It's all about those right questions.
Absolutely. And speaking of asking the right questions, it's interesting because both IRCC and Maine, they operate in this environment where interest rates are huge.
Huge, yeah.
You mentioned earlier, rates have been all over the place.
Oh, my goodness. Don't even get me started.
But the Fed, what they decide to do with rates in the coming months could really impact these companies.
Oh, for sure. And that kind of brings us to our big picture wrap up here.
Okay.
We've explored these 3 companies. Each of them is offering that tempting 8% yield.
Right.
But as we've seen, it's not just as simple as chasing the big number.
Absolutely not. There's a whole world of high-yield stocks out there.
Oh, I'm sure.
Each one with its own story, its own risks, its own rewards. Today's deep dive, this was just a taste.
A little taste, a little appetizer.
Exactly, a little appetizer. It's vital that you do your own research, know how much risk you're comfortable with, and remember, diversification is your friend.
Oh, diversification. You took the words right out of my mouth.
Always a good strategy. Don't put all your eggs in one basket.
Never put all your eggs in one basket. And here's something I think is really important to consider as we're, kind of wrapping up this part of our conversation here.
Mm-hmm.
We've talked about, the potential of these high-yield stocks, but we haven't really touched on what I think is the big elephant in the room.
Okay, and what's that?
The Federal Reserve.
Yes.
What impact will their future interest rate decisions have on these companies? Will higher rates make them more attractive? Or will it squeeze their ability to maintain those juicy dividends?
It's a great question. It really is.
It's a question worth pondering, wouldn't you say?
Absolutely. And it speaks to the constantly changing nature of investing.
Oh, yeah.
It's not just a one and done, set it and forget it kind of thing.
Right.
It's about staying informed. It's about being ready to adapt. It's about never stopping learning.
Oh, well said. And on that note, listeners, we're going to leave you with that thought-provoking question to ponder.
Yes. Do some pondering.
Yeah. Until next time, happy investing.
Happy investing. It's like that old saying, right? Past performance is no guarantee of future results.
Words to live by, my friend. Words to live by.
Especially in the world of investing. In Maine's case, we were just talking about them. It's super important to remember that they're operating in a space that's really sensitive to those interest rate changes, right? So, how the economy is doing as a whole.
The big picture stuff?
Yeah, it all ties back to how well those smaller businesses that they're lending to are actually doing.
That's a really good point. So they could be doing great, but if those businesses start to struggle...
Exactly. It could be a bumpy ride.
Bumpy ride, for sure. Okay, so to kind of wrap up Main Street Capital here.
Yeah.
Solid history, right?
Yep.
They've got that interesting kind of niche...
that first dibs strategy.
Yeah, that first dibs lending strategy, exactly. And, of course, you can't forget about that attractive dividend.
Always a good thing.
Always a good thing, especially these days.
Mm-hmm.
Okay, you ready to meet our final contender in the 8% yield lineup?
Hit me.
All right. Last but not least, we've got Ares Capital.
Okay.
Ticker symbol, ARCC.
All right.
Now, like Main Street Capital, they're also playing in that private credit sandbox.
Got it.
So providing financing to those, not so big businesses.
Right.
And get this, their yield sits at a cool 8.9%.
Oh, okay. They're upping the ante.
They are bringing the heat.
All right, I'm listening. Tell me more.
Right. This one's interesting. But, and you probably saw this but, coming from a mile away.
There's always a but. Right.
On the but. There's this thing called a coverage ratio. And apparently it's kind of a big deal.
It is a big deal.
So break it down for me. What is this coverage ratio? And why should I, as an investor, really care about it?
Okay, so the coverage ratio, It's super important when you're looking at dividends because it basically tells you how easily a company can actually afford to pay those dividends.
Okay, from their earnings, right?
Exactly. Like, are they really having to pinch pennies to make those payments, or do they have some breathing room?
Got it.
And a strong coverage ratio, which ARCC has.
Okay.
It means they're not sweating it.
They're not, like, robbing Peter to pay Paul.
Exactly. They've got it covered, which is a good sign for investors.
Yeah,
right?
yeah, nobody wants to be banking on those dividends, and then all of a sudden it's like, oh, sorry, we can't afford this anymore.
Exactly. Dividends aren't guaranteed. It's important to remember that.
They are not at all. So, okay, I'm with you so far. They're making money. They're sharing the wealth. They're not sweating about it.
Pretty good combo.
It is a pretty good combo. But here's where I get a little tripped up.
Okay.
The article mentions that ARCC has actually, get this, trailed behind the S&P 500 over the past 5 years.
Interesting. How does that happen?
That's what I'm saying. How does that compute with everything else we've just talked about?
That's the thing about the market, right?
It's unpredictable.
It really is. As much as we look at past performance, it's not a crystal ball, unfortunately.
Right.
It could be any number of things. Maybe other sectors were just super hot during that time, or maybe ARCC ran into some specific challenges in their corner of the market.
Okay, yeah, that makes sense.
It just goes to show you there's always more to the story than just looking at the yield.
You got to peel back those layers.
Exactly.
Do your research.
Don't just jump in because there's a shiny 8% hanging out there. Precisely. You got to understand what's driving that performance. And with private credit especially. You got to understand their lending practices, the industries they're involved in, how they're managing risk. It's all connected.
That's a really good point.
Yeah.
Okay, so to recap Era's Capital here, high yield, strong coverage ratio, but, you know, a little bit of a head scratcher when we actually look at their track record compared to the broader market.
It's not a bad thing necessarily.
No, not at all.
Just something to be aware of.
Right.
Do your due diligence.
Always. Due diligence. Ask the right questions.
Exactly. And speaking of asking the right questions, you know, it's interesting, right? Because both ARCC and Maine, they're operating in this environment where interest rates are.
Oh, don't even get me started on interest rates.
Right. They're all over the place.
Bonkers.
And what the Fed decides to do with those rates in the coming months, that could have a huge impact on these companies.
Oh, for sure. Big time. And that kind of leads us to our big picture wrap up here. We've explored these 3 companies.
Right.
Each dangling that tempting 8% yield.
Right in front of our faces.
Right. But as we've seen, it's not as simple as just chasing the big number, right?
Absolutely not.
It really is. It's kind of like walking that tightrope, you know what I mean?
I know what you mean.
You want those big yields at 8%, you know, it's tempting. But
it's seductive, for sure.
It is.
Yeah.
But you also have to realize that there's always another side to that coin.
Absolutely. Always a flip side.
Right. There's always a potential downside.
Risk and reward, they go hand in hand.
They do. So as we kind of put a pin in our deep dive here into BDN, Maine, and ARCC.
Our 3 contenders.
What's the one big takeaway you hope our listeners are walking away with today?
I think, you know, if there's one thing I want to really hammer home, it's this: don't be blinded by the allure of those high yields.
Okay, yeah.
It's easy to get caught up in those big numbers, but...
Shiny object syndrome, right?
Exactly. It's like a shiny object. It catches your eye. It looks appealing, but you gotta pick it up. You gotta turn it over. You gotta really understand what you're dealing with before you decide if it deserves a spot in your, you know, investment treasure chest.
I love that analogy, the investment treasure chest. I might have to steal that from you.
Feel free.
But you're absolutely right. You got to do your homework, folks. All right. And on that note, that wraps up our deep dives into the world of 8% yield stocks.
It was a wild ride.
We went from REITs to BDCs. We explored private credit. And hopefully along the way, we've armed you with some insightful questions to be asking as you navigate your own investment journeys out there.
Exactly. Knowledge is power.
A well-informed investor is a confident investor.
Couldn't agree more.
Until next time, everybody, happy investing.